Folks, welcome back to the Tailored Tax Show, the podcast that helps highly paid, highly taxed, high profile, high net worth, and ultra high net worth taxpayers save a bunch on taxes legally. Today's episode, we're going to look at how you could use life insurance strategically if you're in real estate. So, my name is Terrence Taylor. I'm the co founder of Tailored Tax, and I am an enrolled agent. And this is my partner, Big Al Darnell Jr. So, what's up, Big Al?
What's going on, everybody? I'm Big Al, and I love my mama.
Yes, and Big Al is also an enrolled agent. And as we like to do on the Taylor Tax Show, we like to share with you information that helps you to save on your taxes. Today's topic, Big Al, let's jump right into it. Life insurance and what it can do for you if you're in the real estate space. So the first thing, Big, I think there are like 7 things it can do, to be
Yeah,
fair. I'm going to cover the first three, and I'm going to hand over to you to cover the last four. But let's
correct.
start off with the first one. So life insurance as collateral, folks, for real estate loans. That's a no-brainer, right? So banks, in fact, tend to like this. So they will ask you as a lender as a borrower, to take out a life insurance policy that would cover your loan. So in case something happens to you, they get paid. Now, of course, when this happens, some of us feel a certain way about it, like these banks, like, they're greedy, why they ask me to do this, but there's some benefits, right, Big Al? So one of the benefits is it protect the loved ones of the real estate investor from having to inherit any debt, right? Of course, the bank gets the security that it needs as the lender. It also improves your chance of actually getting the loan. So let's take an example. And Big Al, I've been in this, I've actually had this happen where I took out a loan to buy a property in Nairobi, Kenya with my beautiful wife, Winnie. And the bank that gave us the loan, Echo Bank in this particular case, required me specifically to take out a life insurance policy. Now, at the time, this was before I really understood taxes and all the benefits to life insurance. So I must admit, I was a bit like Drake. I was in my feelings about that. Like, why did I ask me to take out life insurance? But now I completely get it, right? But let's use concrete examples for the US market, since these are the folks we love to talk to the most. So let's suppose, folks, that you're taking out a mortgage that's worth half a million, 500,000 on an investment property. Yes, most likely not in California or New York, because we know those property prices are much more expensive. You could take out a term life insurance policy for that same amount, and that would be relatively inexpensive, and it would ensure that the loan is covered, right? Most US loans for especially investment property tend to be 20 years or less, Big Al? So 20-year term, 15-year, 10-year term, if you can get 15-year term. 10-year term, you can definitely get. 20-year term, you can get. So that's one, Big Al. Any thoughts from you before I go to the next one?
No, I think you covered it well with the example, a personal example for the investment property in South Africa.
All right, cool. And the next one is something we also spoke about when we did the previous podcast, and this is funding what's known as a buy-sell agreement, but now this is specific to a real estate partnership. So similar to buy-sell agreements in a regular business, how this one works though is in real estate partnerships, the buy-sell agreement then will be what will be used to fund the money that may be used to allow a surviving partner to buy out the deceased partner's share without having to liquidate the partnership. And this is the important thing, it just provides that continuity. So the benefit is it will keep the property ownership stable. It also prevents forced sales or conflict with heirs, right? And let's assume this might actually happen. You never know. Big Al and Terrence go into a real estate portfolio partnership, and we decide to build up a portfolio that's in the beginning worth 2 million. Since you're out in Cali and I'm in Texas, most likely we're buying stuff in Cali. We're getting into 2 million quickly, right? So what we could do is each of us could actually take out a policy and be the owner of a policy to insure each other. So I would be the owner of a policy to insure Big Al for 1 million, and Big Al will be the owner of a policy to insure me for 1 million. And that would ensure that there's a smooth way to buy out each other's interests in the case of an unfortunate death of one of us. What about that one, Big Al? Anything you want to add?
No, that makes sense because if we do get into a partnership, and we have a portfolio with that type of money in it, which isn't beyond the realm of possibility, very close possibility, that definitely provides an extra layer of protection for each of us and our respective families, which might not be as savvy as we are with managing that portfolio and expanding it and making sure that we get the returns, the expected returns that we know that we could get with our level of management. So yeah, I think it's great. You're good.
Over time, you now have a pot of money that you could tap to be able to make a down payment on a property. So, for example, Bigger, let's assume that in that example we spoke about where we're buying a portfolio that's worth 2 million and we're each bringing a million to the table. If I have a policy that has enough cash value in it, I could actually tap it for the down payment for my part of the down payment money. And let's, for argument's sake, say that we're looking at making a down payment of 20%. So we got to come up with 400K. So that's 200K each. If I built up cash value in my insurance policies, and for argument's sake, I have 400K worth of cash value, I could take out a loan for 200K, put that as part of my down payment, and that's amazing, right?
Oh,
The
100.
great thing about this, as we've said often, is when you do take out a policy loan from a life insurance policy that has cash value, that is a tax-free event. So you get tax-free access to the funds. And also, sometimes when people are in the midst of buying property, especially for investment, they may need to liquidate assets to be able to fund that. And with this strategy, you don't need to liquidate your assets. So there you go, Big Al. Any thoughts before I hand over to
Yeah.
you?
Yeah, no, I think like to me that's probably the number one of the like I'd probably put it as number one reason of using in an insurance policy for real estate, looking at it from a tax lens. Because if I can build my own bank to cover the down payment, then what it does is it prevents me from ruining my cash to oh man, I forgot it that quickly. What's the DTI, debt to income
Yeah,
ratio,
yeah.
as well as other ratios between our net worth and reserves and things of that nature. So now and then it's non-taxable as well. And then on top of that, you don't have to pay it back exactly. So it's unless you want to. So and on top of that, if it's the right type of policy, you get to continue to make money on the money amount that you borrowed. It's a win, a win, a win, a win. And I like that number three, the buying real estate down, building a real estate down payment using the cash flow from cash value from your life insurance policy, probably the most. No, thanks for explaining that more. I'm gonna rapid run through. Yeah, go ahead.
I was just going to say one of the things that I've been doing since we started this series is I've been geeking out on insurance, folks. So like I'm learning about Nelson Nash and infinite banking using whole life, and I'm learning about the history of index universal life and universal life. And one thing that I've come up on, Big Al, is I've actually changed my thinking a bit about whether I would pay back the loan or not. In the
Mm,
past, like you, I would say like, hey, and I think I started off by sharing with you, you don't even have to pay back the loan.
yeah,
And what I realized is like it actually makes sense to pay back the loan and pay it back in such a way that it builds up even more cash value for you in the future. Because in that by doing that, you make sure that the policy stays in force
yeah.
and that it actually pays off as a legacy as well.
Period. Period. Yeah. It's the thing is having like this cyclical access. I think is a bigger benefit than just
That's it.
reducing it down to its minimum and then
That's it. That's it.
so yeah. All right, great. So the next four, I'll quickly go through these. Number
Yeah.
four, protecting heirs from estate taxes. So we all know that. By the way, what's the estate tax range again? Is it like 29?
So right now, I think the latest for individuals is 13.99 million, where you get an exemption. So obviously, as a couple married filing jointly, that's 27.98 million.
Okay, got it. Perfect. So now So let's just say 28 million. All
Yeah,
right.
exactly. Just to make it simple.
Exactly. So 28 million. So imagine having over $28 million worth of assets. Or
Congratulations to you for those who do. Well done.
100%, 100%. Yeah, it's a huge win for you and your family in building generational wealth, which is a very not overused, but a highly used phrase right now. That concept of building generational wealth. But if you have an estate that's worth over $28 million, then by and large, you're probably going to have some real estate involved in this portfolio. It might not just all be stock or your business is owned, et cetera, et cetera. So now, with that being the case, whenever this estate is going to be taxed from a real estate standpoint, uh, the value of properties, then you're going to have to pay estate taxes on that value above $28 million, with or for $13.99 million or whatnot. For an individual scenario, having life insurance or having a life insurance policy in order to help protect your heirs from having to come out of the pocket or liquidate an asset in order to pay off this estate taxes is to have another insurance policy, to another life insurance policy that will fund the estimated taxes that your family is going to incur at your graduation from this stage of life, this mortal coil that we're routing. So now there's a couple of things I want to make sure that you think about when it comes to this. And number one, because Terrence and I had a couple of discussions and with some of our strategic partners about the convenience and I'll talk about this more later, convenience of having a revocable versus an irrevocable trust. Whereas with a irrevocable trust, it's not going to be counted in your individual estate, it's its own entity. Whereas things in your revocable trust, which a lot of your assets and real estate might just be in your revocable living trust. And this is also something we suggest because we all know about the step up in basis that your children get when it's from an individual to their individual heirs and not from an entity to an individual. So anyway, so that's once again a case by case basis, but this is a beautiful opportunity for you to make sure that you not just pass down millions and pass down wonderful assets that generate this generational wealth to the next generation, but you also make sure that they're not burdened with making some very big decision on possibly liquidating it and unwinding everything that you set up just to handle the taxes. Yeah, so it's something you really definitely need to think about, and life insurance is a big way of avoiding that in a very tax efficient manner. Next, that's supplementing rental income in case of disability or death. Now, here's the thing: is that the beautiful thing about rental income is that it's supposedly a passive income. All right, so it's not like, hey, guess what? I'm disabled, so we need to figure out how to get to some more rental payments to us. What you more than likely have to do is to get a different property manager having that in place. However, there is one thing to think about is that if you are disabled and you have to sell this property, all right, or if you pass away and you don't have the funds to pay, or your heirs don't have the funds to pay it off after you pass away, having that insurance definitely helps supplement your income in the case that you have to let go of that property, making sure that your heirs still have monthly income to come in to keep all the mortgage payments and everything in place after you become disabled. But you would need to make sure that you either have a completely separate disability policy or that you have some sort of rider on that policy in order to include this disability clause, which Terrence would know a lot more about than myself. Number 6, leveraging life insurance for real estate investments via trusts. All right. So a trust. Terrence, could you give us a quick, third grader or eighth grader explanation of what a trust is?
Want me to explain it to you like you're a 3-year-old?
Yeah, there it is. That's probably what I was going to say.
Big Al has 2 beautiful daughters, now 6 and 8, and my children are much older than that, but I remember that stage.
Yeah.
So think of a trust as a place for you to store things that are very valuable to you, where it's also very clear where those things should go should something happen to you, or who those things should go to should something happen to you. And the trust is such a brilliant storage vehicle that only certain people can get access to it. So like, those meanies that are trying to come in and take your stuff away because someone has sued you and that kind of stuff. No, trust wouldn't allow that to be done. It strictly gives your things that you've put into it, assets, to the people who you want to inherit those assets when you graduate and go meet our maker.
100%. And I appreciate that because, see, when we're talking about life insurance, most people know that, all right, guess what? With life insurance, we have the person being insured and then we have the person receiving the funds in the event of the death. So, especially when you have multiple kids or underage children, in that situation, it's best for it to go to a trust, and the trust is going to have a fiduciary, which will then have the means to make the payments to make sure that you don't lose any properties that you have because of the kids being underage or the kids you having multiple kids and you're relying on them to pull the money to pay for this house. If you want this house to remain in the portfolio even past your passing, it's best to put the house in a trust and to have the life insurance as the trust as the beneficiary of the life insurance so that it receives the funds in its trust bank account to make sure that these payments continue to go, or for the trust to be qualified to assume the mortgage in your absence and so forth. So that's using life insurance for real estate investments via trusts. All right. It just helps take out a lot of the guesswork or the required mutual agreements of your heirs in the event of your passing. And then finally, yeah, talk to me.
Big Al is being very nice. It helps to avoid the inevitable fights about who gets what and who was loved more and why is this person getting this. And so folks don't even get to enter into that conversation, and we don't need to go to court for people to be fighting stuff because the trust is very specific. It says who gets what and the story.
Yeah.
Back to you, Big Al.
Hey, well, thank you. And finally, legacy planning and gifting real estate. Now, here's the thing is that, and this is why I really think you should have a conversation with Terrence or some phenomenal tax strategist as well, is because this is where strategy comes into play. And I think it's an ingenious, kind of simple strategy, but it can be complex depending upon your individual situation. Imagine this. All right, so I'll tell you a little bit about my situation since Terrence told you a little bit about his, but we have a family home in Alabama, and there are 5 living children left over. All right. So now all 5 of us literally with our dad and our mom, which did a little bit here and there physically, but it did a lot in every other way, financially and support and everything else in building this family home in Alabama. Right. So now, my pops, he passed passed last year. So then, amen. And in the event anything happens to my mom, I know my mom wants to make sure that we're not fighting over the family house. Now, here's where this legacy planning and gifting real estate comes in, is that by us having a family meeting and discussing how would it benefit the family the most and which child is, I guess, more diplomatic in making sure that everyone will have access if they're the one that is assigned this house. There could be a situation where you could say, hey, yes, I'm going to allow this child to inherit the property because this is going to help either their family, or I know that they're going to make sure that everybody's going to be able to come back during Christmas and other holidays in order to enjoy the benefit of the family house, and they're not going to sell it and take it out of the family name since we literally used our sweat and tears, maybe a little blood. I think I hit my finger one time, or my dad did, while we were hammering. We did a lot of the framework, but
It's not complete until there's a little bit of blood.
yeah, so blood, sweat, and tears into it. So my mom will know, hey, this child isn't going to sell it. Is going to make sure everybody can come to it when there are times of trouble or for family events, et cetera, et cetera. So now, guess what? If that house is worth $250,000 or whatever the amount is, then that child could get the house. But guess what? The other 4 children, she can have it in her insurance policy. If it's $1 million insurance policy, that each of the other 4 kids get the value of the house as well. So each of the 4 others gets $250,000 in cash payout, and this heir doesn't get anything from the life insurance, but they get a $250,000 house. You see what I'm saying? So from a strategic standpoint, you're able to do legacy planning using life insurance in concert with the real estate in order to make all parties satisfied, because a lot of these other children might have wanted the cash anyway. And this is going to allow you to make sure that generation after generation, this house, family house, stays inside of the Darnell name. Or if it's a daughter, our blood, so to say. But yeah, that's all I wanted to say about that. Any thoughts, my man, Terrence?
No, it's as you say, it's such a powerful strategy, right? So it just allows with good planning to make sure that people get what they need, when you're leaving behind a legacy. You leave behind a legacy in such a way that you are able to pass on what you want and pass it on in the way you want. So there's so much more that we could share with you about this, but let's just share with you a few considerations for your benefit, right, before you implement these strategies. So the policy type, we talked about this even in the previous podcast, is important to think about. Are you thinking about term insurance, which can be cost effective for needs that have a finite period of time, whereas permanent insurance that has cash value is always better for longer term strategies. Ultimately, it will be more cost effective because the policy will still be in force, still be available to you. The impact of a loan. So Big Al and I talked about this briefly. So when you're borrowing from a policy, it will reduce the death benefit. Previously, there was some thinking that said like, hey, you don't even have to pay back the loan. There's some truth to that because the loan is collateralized by the death benefit, so it's taken from the death benefit. But given what you're trying to do when you have life insurance, you're ultimately trying to preserve your capital and preserve capital and assets and provide it for future generations. So it's always more advisable to pay back those loans. Tax implications. So Big Al has already offered that you could talk to us or anyone that you believe is a good tax professional, qualified tax professional, to help you to think through how to structure these things and get the benefits from it and make sure you avoid unintended consequences, including this last thing that we'll share. So there's something called a MEC, Big Al, and like once you get into this space, it's a buzzword, but it stands for Modified Endowment Contract. It's a way that the IRS keeps track of whether or not your life insurance policy should be treated as a life insurance policy with all the tax benefits of tax deferred growth and then distributions that can be tax-free, and especially loans that are tax-free. Or if you've now crossed the line into what it's called a modified endowment contract, and then you get treated as if all that money and all the money that you want to pull out is actually an investment, and then you have a lot of taxes. So you want to make sure that you are working with a licensed insurance professional who can design your policies in such a way that you avoid them becoming insurance professionals. So feel free to reach out to me, Terrence, at taylortax.ai. So TERRENCE at TAYLOREDTAX.ai, or Big Al at taylortax.ai. Big Al, tell them about Tax Strategies GPT, one of our favorite tools.
Yeah, 100%. So Tax Strategies GPT is hosted on the OpenAI platform, just like ChatGPT, except it's specifically going to assist you with any questions that you have surrounding federal taxes. So make sure that you go check it out, Tax Strategies GPT on the OpenAI platform. Plug in your questions and see what it gives you. If there's any further explanations needed, you can ask further questions, or you can contact us at the emails that Terrence gave you. Anything else on the horizon that we wanted to reveal, Terrence?
Yes, Big Al. This is something for those of you that like retreats. I don't know if you'll ever put a retreat and tax strategies together. Taylor Tax is bringing you the first tax strategies retreat for 2025. So it's in stealth planning mode, but here are some of the things that we've thought about. What if over a weekend, 2-day period, maximum 3 days, we could bring together 20 selected people who have to qualify for being there, all of our key strategic partners, and help each of those 20 taxpayers, and feel free to bring a spouse if you are married filing jointly. These taxpayers can walk away with enough knowledge and a roadmap and implementation plans to save $500,000 to $1 million in taxes. So when Big Al and I thought about that, we thought, yes, we should definitely do this, right? Big Al, I think I was sharing with you, I watched the Netflix documentary, Mr. McMahon, that talked about the building of the WWE. So for those of you who are wrestling fans, you will understand this reference, but here's a person that built a $1 billion plus business empire, and he had this vision for something called WrestleMania, and he went into designing WrestleMania. So I think of this as a WrestleMania of sorts in the tax arena.
All day, all
The
day.
idea, folks, is to make sure you get so much value that when you pay us the $50,000 to come, you're like, that's 1/10 to 1/20th. 5 to 10% of the value that we're going to get out of this. Anything you want to add about the tax strategies retreat?
No, I just wanted to mention that you kind of slid that in the price. It is like he mentioned, like Terrence mentioned, we believe, we know that we can save, and we've helped others do it as well. Businesses, individuals alike, save over $500,000 in taxes, actual taxes, not just reduce your taxable income by $500,000, but save $500,000 in taxes. And we're putting it in a format that is non-confrontational, sitting on pins and needles, but it's in a retreat format to make sure that you and your partner can attend, learn, receive the assistance on site, and save that's $500,000, and doing all that for the very, very economical price of $50,000.
Big Al, you shared this with me. Folks are paying $40,000 to buy Birkin bags.
Yeah.
And when you buy a Birkin bag, you get status.
Yep.
Imagine being qualified to come to the tax strategies retreat, paying your $50,000, and now you get a plan and the strategic experts you need to execute that plan that saves you $1 million to $1 million in taxes perennially.
Yep.
So that's a pretty good deal.
100%. We're talking about, though, like if you're paying for private jets just to fuel that bad boy, you're going to be paying close to that. If we're talking about people that are wearing nice AP watches, that are driving Rolls Royces, Bugattis, and all these other supercars or whatnot, this is not that much at all. So the thing is that we want to make sure that we are addressing the very people that we know these strategies are going to make the biggest impact on. And please believe those aren't the only people that we can help. That's just who this particular retreat is for. But please, exactly. And so everybody that applies, whether you want to pay the $50K or not, that doesn't mean that you're going to be able to access this event. Like Terrence mentioned, you're going to have to qualify. But I want to make sure that nobody else feels that with their situation, that we can't help them, whether you're willing to pay twice as much or you can only pay 1/10 of that amount. We have products and service offerings that can definitely help. So just make sure that you stay in touch. It should be happening this year, and we're looking forward to revealing more information about it. So stay tuned.
To share a really good chat with a techie who's still in tech, and very savvy person, has made a shit ton, that is a technical term, of money, and they're really tax savvy. And when I told him about the retreat, he was very excited. He's like, sign me up, but like, bring it to New York. I'm like, I'm not sure about New York, because we want to make it a venue that is conducive to the retreat, right? We want you to get in touch, right, with your finances and saving on your taxes. And then we also talked about a friend of his who has over 25 million in just their IRA, in their 401k. And you and I have been spending a lot of time making sure we are very versed on retirement savings and how to help people to save taxes when it comes to what they do with their retirement income. So folks, just a little teaser about the tax strategies retreat. You'll be hearing more about it as we go along. Big Al, thank you so much, man. This was so much fun, folks. Thank you, and see you soon.
Cheers.